Look at the financial news lately, and you'll see a very specific story being told. The stock market is routinely breaking all-time highs, artificial intelligence companies boast multi-trillion-dollar valuations, and national unemployment remains comfortably low. But step away from those broad headlines, and the picture on the ground changes. Millions of households are quietly struggling to cover their monthly rent, keep up with basic grocery bills, and manage mounting debt. It creates a strange kind of psychological whiplash. You are repeatedly told you live in an absolute powerhouse of an economy, yet your own bank account feels like it is draining faster than ever. So what exactly is happening here? Why do the broad macroeconomic numbers insist we are thriving when the microeconomic reality for so many people says we are broke? That disconnect is not in your head. It is a very real, measurable economic phenomenon, and the explanation is buried right there inside the data. We can start by looking at this diagram of total economic output. When economists say the economy is growing, they are strictly talking about the overall volume of this pie expanding. They're not talking about how those pieces are handed out. Notice how the vast majority of the new growth here is swallowed up by corporate profits. Unless you own a significant amount of capital in those specific booming tech and AI sectors, you don't feel that prosperity. Instead, your slice of the income pie stays completely flat, even as the heavy costs of housing and childcare drop right on top of it. Then we run into the math trap of inflation. We hear constant celebrations from policymakers and the press that inflation has finally cooled down from its peak a few years ago. But look at this line graph tracking the actual price of everyday essentials. Cooling inflation just means the line stops shooting straight upward. It flattens out. It does not mean the line goes back down to where it started. That horizontal dashed line represents a permanent gap. You are now stuck paying those significantly higher, locked-in prices for everything from groceries to auto insurance. Cheering for cooling inflation ignores a crushing reality on the ground. Consumers are forced to adjust their entire baseline budget to survive at that peak cost, month after month. To actually achieve that slowing inflation, central banks relied heavily on one specific tool, raising interest rates to cool down spending. But those higher borrowing costs create an aggressive penalty for everyday people. They act as a multiplier, turning standard financing into an enormous financial burden at the micro level. Look at this flowchart starting with a standard $1,000 credit card balance. As the interest rate dial cranks up, those multipliers kick in. The final cost of carrying that debt inflates rapidly and turns red, pushing up the required payments on everything from auto loans to existing credit cards. While you manage those debts at home, the workplace is undergoing its own stress test. Artificial intelligence is driving massive valuations in the stock market, but it introduces severe uncertainty for the average employee. To avoid losing ground to automation, workers face the reality that they must constantly reskill and adapt just to maintain their current economic standing. The average American ends up caught in a squeeze. You pay permanently higher prices, penalized by expensive interest rates, and you must work harder to ensure software doesn't replace your income. Professional investors don't base their strategies on a single optimistic news segment. If we step back and look at how they view the data, we see a complex dashboard of conflicting signals. Relying on one broad metric, like total GDP or a monthly consumer price index report, provides an incomplete picture of financial health. It obscures the friction happening underneath. To accurately gauge where the economy is heading, you have to cross-reference multiple composite indicators. That means looking at employment figures alongside corporate earnings and checking consumer spending right next to Federal Reserve announcements. The numbers don't lie, but they do require context. A soaring aggregate stock market will not cover a family's rent hike, and an inflation rate dropping to 2% does not make a carton of eggs cheap again. Once you understand this gap between the macro metrics and your micro reality, you can stop feeling gaslit by the news. Instead, you can look closely at the data that matters and start making clear, defensive financial decisions for your own household.